I'm watching something unfold in Canadian real estate markets that should terrify every American homeowner, mortgage holder, and bank investor, because what's happening north of our border represents the most predictable housing collapse I've analyzed in 7 decades of studying real estate cycles. Canada's housing bubble has reached mathematical extremes that make 2006 American subprime lending look conservative, and the systematic correction now beginning will cascade across North American financial institutions with precision that no monetary policy intervention can prevent. What alarms me most about the Canadian situation isn't just the magnitude of the price distortions. We're talking about average home prices that reached 14 times median income in cities like Vancouver and Toronto. It's the systematic leverage that Canadian households have accumulated during 15 years of emergency interest rate policies that made mortgage payments temporarily affordable, while creating debt burdens that become mathematically impossible to service when rates normalize to historical levels. The numbers are staggering when you calculate them through the lens of household debt sustainability. Canadian mortgage debt reached 220% of disposable income, while interest rates remained artificially suppressed at emergency levels. That's higher than American household leverage ever reached, even at the peak of our subprime bubble in 2006. But unlike our subprime crisis, which was concentrated among marginal borrowers, the Canadian bubble encompasses mainstream middle-class households who assumed mortgage obligations based on payment calculations that only worked at emergency interest rates. I've spent my career studying leverage mathematics, and the Canadian mortgage situation represents systematic insolvency disguised as affordability through interest rate manipulation. When you borrow 6 times your annual income to buy a house, you're not buying real estate. You're making a leveraged bet that interest rates will remain at emergency levels indefinitely and that your income will grow faster than your debt service obligations. That's not home ownership. That's speculation financed through systematic monetary accommodation. The Bank of Canada's interest rate normalization has triggered the predictable mathematics of leveraged speculation. Mortgage payments that consumed 35% of household income at 2% interest rates now consume 55% at 5% rates, pushing hundreds of thousands of Canadian families into systematic insolvency that cannot be resolved through payment deferrals or mortgage modifications because the underlying debt levels exceed any realistic capacity to service at normal interest rates. Regional banks across Canada face systematic mortgage defaults that will cascade through their balance sheets with mathematical precision as interest rate resets force mortgage renewals at payment levels that exceed borrower capacity. Unlike American mortgages, which typically offer 30-year fixed rates, Canadian mortgages must be renewed every 5 years, creating systematic refinancing pressure that forces borrowers to accept current market rates regardless of their capacity to pay. The Royal Bank of Canada, Toronto Dominion Bank, and other major Canadian financial institutions have mortgage exposure that approaches 70% of their total loan portfolios, creating systematic vulnerability to housing price declines that American regional banks faced during our subprime crisis. But the Canadian situation is actually worse because the debt levels are higher, the leverage is more extreme, and the monetary accommodation that created the bubble lasted longer than our pre-2008 credit expansion. What makes this particularly dangerous for American investors is the systematic interconnection between Canadian and American banking systems through cross-border lending, derivative exposure, and shared capital market funding. When Canadian banks start recognizing systematic mortgage losses, their credit ratings will decline, their funding costs will increase, and their capacity to support credit creation will contract, affecting North American liquidity conditions and commercial real estate financing on both sides of the border. The immigration-driven demand that supported Canadian housing prices during the bubble expansion is now reversing as economic opportunities deteriorate and housing costs become prohibitively expensive even for high-skilled immigrants. Canada's immigration targets assumed continued economic growth and housing affordability that no longer exist, creating systematic pressure for immigration flows to reverse toward more affordable jurisdictions, including American metropolitan areas with better employment prospects. This immigration reversal creates additional pressure on Canadian housing demand while simultaneously increasing demand pressure in American housing markets that are already experiencing affordability constraints. The demographic arbitrage that allowed Canadian real estate to maintain artificial price levels during the bubble expansion will now work in reverse, accelerating price declines in Canadian markets while adding demand pressure to American markets that could trigger our own affordability crisis. The currency implications of Canadian housing collapse extend beyond immediate real estate values toward systematic pressure on the Canadian dollar as foreign investment in Canadian real estate markets evaporates and domestic capital seeks more stable jurisdictions. The Canadian dollar has already declined significantly against the U.S. dollar, but the housing collapse will accelerate that decline as international confidence in Canadian economic stability deteriorates and capital flight accelerates toward American assets. But here's what should really concern American investors. Our housing market exhibits many of the same systematic vulnerabilities that created the Canadian bubble, just with different timing and slightly different leverage structures. American home prices have reached levels that require dual high incomes to afford median homes in major metropolitan areas, while mortgage debt service ratios approach levels that become unsustainable when unemployment rises or interest rates increase beyond current levels. The Federal Reserve's interest rate policies created the same systematic moral hazard in American real estate markets that Bank of Canada policies created north of the border. Low interest rates made housing speculation appear profitable while encouraging systematic leverage accumulation that becomes destructive when monetary accommodation ends. The mathematics are identical. Only the timing differs between our two housing cycles. American regional banks face systematic exposure to commercial real estate loans that exhibit the same leverage characteristics as Canadian residential mortgages. Office buildings, retail centers, and hospitality properties purchased with cheap debt during the accommodation period now face refinancing requirements at interest rates that make cash flows inadequate to service existing debt levels. The systematic defaults approaching American commercial real estate will follow the same mathematical progression as Canadian residential mortgage defaults. The construction industry implications cascade across both economies because residential construction employment supports millions of jobs that disappear rapidly when housing demand collapses. Canadian construction employment is already contracting systematically as new housing starts to decline in response to affordability constraints and tightening credit conditions. American construction employment will follow the same pattern as our housing market adjusts to higher interest rate reality. Retirement security implications affect both countries because household wealth accumulated through housing appreciation represents the primary retirement savings vehicle for millions of middle-class families. When housing values decline systematically, retirement planning assumptions collapse, forcing families to extend working years, reduce consumption, or accept lower retirement living standards. The demographic implications compound over decades as housing wealth destruction affects multiple generations simultaneously. International investment flows between Canada and the United States will shift systematically as Canadian real estate becomes less attractive to foreign buyers, while American real estate maintains relative stability and better long-term growth prospects. This capital reallocation affects currency exchange rates, interest rate differentials, and cross-border lending relationships that influence monetary policy effectiveness in both countries. The systematic nature of Canadian housing collapse creates learning opportunities for American investors who understand that identical leverage mathematics operate in both markets with predictable timing differences. The Canadian crisis serves as early warning system for American real estate investors who recognize that the same monetary accommodation that created systematic bubbles operates according to mathematical rules that transcend national boundaries. Insurance industry exposure to mortgage default insurance and housing-related derivatives creates systematic risk-sharing between Canadian and American financial institutions that cannot be contained through national regulatory boundaries. When systematic mortgage defaults begin in Canada, the losses cascade through international insurance markets and derivative contracts that spread the damage across North American financial institutions, regardless of their direct exposure to Canadian real estate. The agricultural land bubble in both countries exhibits identical characteristics to residential real estate speculation, with farmland prices reaching levels that cannot be supported by agricultural income streams, but depend entirely on continued monetary accommodation and speculation demand. When housing bubbles collapse, agricultural land speculation typically follows the same mathematical progression as investors retreat from all forms of leveraged real estate speculation. Energy sector implications affect both economies because housing construction demand supports significant energy consumption through building materials, production, transportation, and heating systems installation. Systematic housing demand destruction reduces energy consumption, affecting oil and natural gas prices that influence energy-dependent regional economies in both countries, particularly affecting areas like Alberta, Texas, and North Dakota. The municipal finance crisis emerging in Canadian cities facing property tax revenue declines will parallel the systematic municipal stress that American cities experienced during our housing collapse. Local government revenues depend heavily on property tax assessments that decline systematically during housing corrections, forcing service reductions and infrastructure investment deferrals that compound economic stress at the regional level. What frustrates me most about this predictable crisis is how preventable it was through basic leverage mathematics and interest rate normalization policies that central banks could have implemented gradually over years instead of allowing systematic bubble accumulation that requires sudden, devastating corrections. Both the Bank of Canada and Federal Reserve chose to prioritize short-term growth stimulation over long-term financial stability, creating systematic leverage accumulation that threatens economic security for millions of families. The investment implications for patient capital require positioning for systematic real estate repricing in both countries while avoiding the leverage speculation that will be destroyed during the correction process. Physical real estate ownership in carefully selected markets with sustainable price levels offers protection against currency debasement, but leveraged real estate speculation represents systematic wealth destruction during deleveraging cycles. Cross-border supply chain implications affect manufacturing and distribution networks that depend on consumer spending power in both countries. When housing wealth destruction reduces consumer spending systematically, the integrated North American economy experiences synchronized demand contraction that affects employment, business investment, and credit creation across multiple industries and regions. The timeline for systematic housing correction follows mathematical progression determined by leverage levels, interest rate increases, and demographic pressures that operate independently of political intervention or monetary policy accommodation. Canadian housing collapse will accelerate over the next 18 to 36 months, regardless of policy responses, because the underlying leverage mathematics have become unsustainable at current interest rate levels. Patient capital must position for North American real estate repricing while understanding that systematic deleveraging creates opportunities for unleveraged investors to acquire quality assets at sustainable price levels. The Canadian crisis serves as early warning system for identical mathematics approaching American real estate markets with predictable timing that depends on Federal Reserve policy normalization and employment market stability. Markets reward mathematical reality and punish systematic leverage with precision that compounds over time regardless of national boundaries or political preferences. The Canadian housing collapse represents systematic correction of leverage accumulation that will cascade across North American financial institutions until debt levels return to sustainable relationships with income generation capacity and normal interest rate environments.